Global finance is standing on the edge of its biggest design upgrade since electronic trading screens replaced pit floors. 5 mighty layers, monetary sovereigns, system-wide regulators, market infrastructure, systemically important private actors, and the vast shadow finance frontier have kept the post-2008 world running. Now, a new ingredient is joining every layer at once: programmable, order-agnostic, blockchain-based value. The next wave of cryptocurrencies and tokenized assets will not overthrow the system. They will weave themselves through it, amplifying opportunity, speed, and resilience for anyone bold enough to adapt. Central banks, the Layer 1 power stations, are already trialing wholesale and retail CBDCs. By late 2025, at least 15 monetary authorities will have live pilots settled in real reserves. These digital sovereign coins are not here to kill Bitcoin. They are the settlement asset that lets tomorrow's crypto rails plug into today's lender of last resort safety net. Expect dual-tier models. Citizens hold e-dollars or e-euros in wallets, while commercial banks sweep balances nightly to their master accounts. The result, 24/7 finality, but still under the watchful eye of price stability mandates. Layer 2, the regulatory mesh, is sprinting to keep up. The Financial Stability Board's 2025 roadmap folds crypto firmly into the mantra, same activity, same risk, same rule. And IOSCO has published disclosure templates that mirror prospectuses for equities. Europe's MiCA regime is live. The US is finalizing a stablecoin statute that forces one-to-one reserve backing at Fed-supervised banks. And FATF's travel rule now covers self-custody wallets above a de minimis threshold. Fragmentation is real, but the direction is clear. Compliant rails will win capital, while anonymous, under-collateralized coins will fade to the margins. Layer 3, the pipes, will look unrecognizable by the end of the decade. Swift's ISO 20022 upgrade already supports on-chain reference fields. DTCC's Project Ion settles US equities in T+0 on a permissioned DLT. CLS is testing PVP for tokenized FX. And Fedwire is studying atomic settlement with FedNow for retail overlay. Wholesale CBDCs will slot directly into RTGS engines, while bridge networks like BIS Project M-Bridge move EHKD, ECNY, and EAED across borders in seconds. Expect programmable escrow, instant repo, and real-time collateral reuse, all catalyzed by smart contracts embedded in the infrastructure layer. Enter Layer 4's giants. BlackRock's on-chain money market fund, JP Morgan's blockchain-based JPM coin network, and UBS-backed Partior in Singapore demonstrate that trillion-dollar institutions consider distributed ledgers a cost of doing business, not a hobby. ETF issuers are vying to tokenize everything from carbon credits to fine art, allowing fractional ownership with intraday liquidity. Mega banks are wiring corporate treasury portals so CFOs can sweep idle cash into high-yield stablecoins at 5 p.m. and back into bank deposits at 9 a.m., compressing the old idle float to minutes. Layer 5, the non-bank frontier, remains the innovation petri dish. DeFi protocols already underwrite over-collateralized loans faster than any bank branch. In 2025 to 2026, we will see under-collateralized lending primitives using on-chain reputation scores, AI-scanned financial statements, and real-world asset NFTs as security. Off-chain oracles will pipe shipping receipts, carbon offset registries, and securitized revenue streams straight into smart contracts. Private credit funds will mint tokenized debt tranches, settling them on permissioned chains, but offering public chain visibility to investors, creating a translucence that traditional CLOs never achieved. So what does this convergence mean for the next generation of cryptocurrencies? Fiat-anchored stablecoins will dominate medium of exchange use cases. Circle's USDC, PayPal USD, and emerging bank-issued coins will link directly to Fed master accounts or ECB target nodes. Their yield will track overnight policy rates, narrowing the gap with bank deposits and erasing the opportunity costs that once plagued stable assets. Commodity-backed and ESG-linked tokens will proliferate. Expect gold bars with serial-numbered RFID chips issuing ERC 1400 tokens, or reforestation credits programmed to burn unless satellite data confirms tree survivability 5 years on. These asset reference coins satisfy regulators by being tangible, satisfy investors by offering yield, and satisfy sustainability mandates via verifiable impact metrics. Modular, interoperable base layers will crush monolithic chains. Roll-up-centric roadmaps on Ethereum, data availability layers like Celestia and cross-VM compilers will let developers choose security, speed, and privacy a la carte. Cross-chain messaging standards such as IBC and Layer 0 will make chain choice as invisible as email server choice is today. Identity will be embedded from block height 0. Decentralized identifiers, zero-knowledge proofs, and privacy-preserving credential wallets will let users prove KYC status to a smart contract without doxing personal data. Regulators get compliance, users keep sovereignty, markets gain frictionless onboarding. AI-driven autonomous agents will transact natively on-chain. A shipping logistics bot will book and pay for port slots in e-euros. A rooftop solar array will auction excess kilowatts to its neighborhood in tokenized energy credits. A gaming guild will manage treasuries through DAO governance modules. Each machine-to-machine interaction mints micro-fees for validators and liquidity providers, expanding crypto's total addressable market beyond human hands. Capital inclusion. Micro DAO treasuries in Nairobi can tokenize invoices and access global liquidity pools denominated in dollar stablecoins, bypassing correspondent bank choke points. Fractional ownership at scale. Real estate tokens let retail investors buy 1/1,000,000th of a Manhattan tower, with rent flows auto-streamed to wallets. Instant, transparent aid, disaster relief. CBDC vouchers can be airdropped to verified residents, time-locked to expire after 90 days and spendable only on approved goods. Sustainability finance. Smart contract-insured green bonds release coupons only if third-party IoT sensors confirm emissions targets, aligning incentives end-to-end. 24/7 secondary markets. Tokenization turns every asset into an always-open instrument, compressing liquidity premiums and widening price discovery. Regulatory patchwork. Disjointed rules can strand liquidity in on-chain silos. The solution? Embrace interoperable compliance layers, lobby for passporting regimes, and architect geo-fenced smart contract wrappers. Oracle attacks and data integrity. Real-world asset tokens are only as strong as their data feeds. Dual Oracle designs, cryptographic attestation, and insurance pools can mitigate single-point failures. Cyber and quantum threats. Post-quantum cryptography and multi-party computation will move from research papers to practical guardrails within 5 years. Early adopters gain reputational advantage. Hidden leverage loops. On-chain rehypothecation multiplies risk the same way shadow banking does today. Built-in margin engines, circuit breakers, and transparent ledger analytics will keep systemic fragility in check. Energy footprint. Proof of stake won the efficiency debate, but AI and IoT adoption will drive transaction volume up. Layer 2 batching and zero-knowledge rollups are critical to cap emissions. Audit your value chain. Map every cash, collateral, and data flow. Identify touch points where tokenization cuts cost or unlocks revenue. Choose compliant rails early. Stablecoin issuers with bank-grade audits will attract institutional capital. Gray zone liquidity dries up fast once regulations crystallize. Integrate programmable money logic. Embed payout conditions, penalty clauses, and carbon triggers directly into token contracts. Lawyers draft the clauses, developers code them, regulators supervise in real time. Hedge on-chain and off-chain risk. Use cross-margin protocols that accept both US Treasury tokens and ETH staking receipts. Maintain fiat liquidity for unexpected compliance costs. Invest in talent bridges. Pair TradFi veterans who know regulatory plumbing with crypto-native engineers who think in composable primitives. The Fusion team will outship pure-play incumbents and pure crypto startups alike. The story arc is unmistakable. Crypto's rebellious adolescence is giving way to its professional adulthood. Regulators are building guardrails instead of roadblocks. Infrastructure operators are embedding blockchain hooks into legacy pipes. Systemic giants are tokenizing core products, and non-bank innovators are rewriting capital formation logic. The winners of the next decade will not be defined by maximalist ideology, but by mastery of interoperability between fiat and crypto, code and policy, public clouds and private keys. $1 in 2030 might start the day as a wholesale CBDC balance at a central bank, spend the afternoon tokenized inside an ETF on a Layer 2 rollup, and end the evening locked in a DeFi collateral vault earning yield, all while remaining fully compliant, auditable, and instantly retrievable. That is not science fiction. Pilots are live, standards are drafting, and capital is already shifting in that direction. So greet the rise of the next-gen cryptocurrencies not with fear, but with informed enthusiasm. They are the connective tissue stitching together 5 mighty layers of global finance into a faster, fairer, smarter fabric. Your mission, whether a policymaker, entrepreneur, or investor, is to learn the new grammar of programmable value and start writing the future before someone else drafts it for you.